So Betfair trading doesn't need to be complicated. It can be quite simple. The structure behind a trade can be quite logical and easy to follow, and the opportunities will occur on a regular basis. Today I will be trading manually about 30 to 50 events, and my automation will trade many times more than that across a range of different markets at different times of the day. But fundamentally speaking, if you look at this trade that I did today, it grossed just about £250, and when we fully hedged that position, that equated to about £100 across the entire market. I don't think there was anything particularly special about this trade, and it's something that occurs on a regular basis. I have illustrated a whole range of strategies that you can use. This was one particular type of trade, and I thought let's go and explore this a little bit more and flesh out some of the detail behind it. If you're interested in Betfair trading and you want to learn how to trade, then visit the Academy where you can do exactly that. If you want to talk to professional Betfair traders, then why not head over to our forum where you can talk to like-minded people, but you can also download additional content. And don't forget to head over to our website to download a copy of Betangel, the cutting-edge software that will completely transform your trading. So there are many different ways of actively trading a market. When you're sports trading, when you're doing a bit of Betfair trading, what you're attempting to do is one of two things really. You either have a strategy and you're waiting for the right market to come along, or you're looking at the market and trying to decide what strategy would fit into that market. And there are many ways that you can actively trade. I hate it when I see people trying to ram down your throat that one thing works or another thing doesn't work, or that their method is better and stuff like this, because fundamentally speaking, there are a whole range of strategies that work, and your role as a trader is to basically match them to the market or identify markets where that strategy is going to work. But basically there's so many different ways of doing it. You could use a little bit of form, you could trade order flow, you could look at on-course activity, the results of prior races. There's just so many things that you can do. But depending upon which stage you're in the market, determines upon what you should do and which one of those strategies would fit. But what I'm going to show you today on this particular trade is something that I do pretty much every day. And I'm going to contrast that as well with another trade that followed soon afterwards to show you and describe some of the thinking that I've gone through and why I did what I did and how that would change depending upon what I see in the market. So without further ado, let's examine this trade in a little bit more depth. So where I'm going to start here is by having a look at some charts. And every market that I trade where something interesting happens, I will capture the chart and then I will archive it probably the following week. But if we look at some charts here, what I'm trying to do is to basically just gather information on stuff that I see, stuff that resonates with me, that I think could be interesting, because it allows me to have a look at all of that stuff and then begin to look for repeating patterns. And that's very often what you see. It all begins, this sort of penny begins to drop in terms of the sort of stuff that happens on a regular basis and the way that the sort of market behaves. Now I do gather data as well to analyze, and that's all done through Betangel. But basically I will collect information on each market and I will collect stuff that's of interest so that I can review it at some point. And I still do that. It's a good learning process. It's a good way of understanding the way that the markets work, and it's something that I recommend that you do. Now I have said before that you need to be careful about using Betfair charts because they are very often not particularly accurate. So I do actually have my own advanced chart that I use. But because I've modified it heavily, it's too complicated to explain in depth and to give you some sort of point of reference. So that's why we're going to be using the charts in this particular video to give you an understanding of what I'm looking at, how I've understood what is going on within the market, and therefore what that graph is likely to be able to tell me in terms of what is likely to happen from that particular point onwards. So if we look at this chart here, it tells a story. This is the chart before I actually got involved, or around the time that I got involved in the market, because I tend to snapshot it at the point at which I look at it and go, aha! But it's important to understand what you're actually looking at when you're looking at a chart. You're looking at price action, you're looking at where the price has been, not necessarily where it's going to go, but it can give you a clue as to where it's going to go, which I will explain in a second. But when you're looking at a chart, you're looking at price action, and when you're looking at a ladder, you're looking at order flow. You're looking at how information is being discounted at that particular moment in time, and you're looking for trends within that information that will drive the price action. But being able to look at a chart will give you a clue as to what's going on within the market, because at any point within the market, it's discounting all available information, and it's trying to find the point at which it will end in that particular market. So for the early market, there's less information discounted into that particular price. And as the market progresses, it tries to find that point within the market that it so desires. It's a path of desire that it will follow. But that path is very wiggly. It goes up, it goes down, it trends all over the place before settling at a final price. And basically where you'll make money from trading is by looking at moments within the market where that's out of kilter with where the final price is likely to be, and then you're actively trading it. So the first thing to note on this graph is if we look at the far left-hand side, you will see in the early market, the price sort of moved in fairly quickly. And there's a logical explanation for this, and that is that Betfair put the markets up the night before, and when they put the early markets up, it's possible that they could be mispriced. It's possible that some of the information that is potentially available about this horse isn't available at that moment in time, or there's just a basic error in terms of the way that the market has been priced, and therefore a corrective sets in on relatively low volume overnight and in the early part of the day. So that's what you can see on the left-hand side, is the market is effectively getting repriced. And on this occasion, the market was repriced down to about 2.5. Now, as the market begins to develop, more money comes into the market, and what you can see on the graph at this particular point is that that money sort of followed the early money basically and started to pull the price in. But as the day progresses, then what tends to happen is that the market develops like a shallow trend as we begin to sort of move through this day. Some of this is dependent upon the type of race. So if you get a very competitive handicap, this is not the graph that you're going to see. A competitive handicap, nobody really knows who's going to win, so the price will meander all over the place. But in markets that are trending like this one, then you tend to find that the money either goes for something or it doesn't. So seeing the early money, the market started to pull this price in a little bit more. So that sort of describes the first sort of bit, maybe the first half of basically what we can see in this graph. So one of the things that I do, especially with betangel, because you can do it multi-screen and you can display loads of information all over the place, is I keep an eye on markets that are coming just around the corner. I'm constantly looking and trying to understand what's in front of me, because that may determine what I do on the current market. I may drop this current market and focus on the next one, or I may just wait, or something interesting may be happening. So I joined this market as we approached, or I could see that the price was approaching 2, because obviously that makes for a natural point within the market. You get a crossover point here, but also that means that you're looking essentially, if you're near a crossover point, as to, will the price bounce? Because as you approach that particular point within the market, it's going to do one or two things. It will crash through 2 and then continue downwards from there, or it will bounce. And getting a bounce at 2 is quite a nice position to be in. So I looked at this market, I looked at the graph, I could see that it was approaching that particular point within the market. I could understand the way that it had got there. So what I was looking for at that particular point was weakness to develop within the market. So when we're looking for weakness in a market, we're basically looking for the backing to dry up. It takes a little bit of practice, but basically if you see wave after wave of backing and the price being pulled down, and then it slowly sort of weakens, and then it gets pulled down again and pulled down, that begins to become more obvious. So what we're looking for is we're looking for a lack of that sort of activity where people are quite clearly trying to take the best price because they can't get filled at the current one. So basically the backing dries up, you're not seeing that sort of tendency within the market, and in fact the price begins to drift. It doesn't mean that it's being laid, it just means that maybe people aren't willing to back it at that price anymore, and there's probably something happening elsewhere in the market that's helping to reinforce that particular trend. But when you begin to see evidence of that, that's probably the time that you want to get involved within the market. And that's what I did basically. I tried to get involved at a moment within the market where it had become pretty obvious that that trend had stopped and that the price was beginning to move out. And what I do as soon as I enter the market is I put all of my closing positions into the market above or below where that entry point is in the market, depending upon which direction I think it's going to go in. And the intention with that is not to specifically nail the exact price that I'm going to get out on. It's basically to get a good average price that I can exit the market. And basically, if I don't think that the market is going to head up in that particular, with any strength, then I basically pull the orders down in order to get them matched. But if I do think that it's going to go a lot stronger, then I just cancel off those bets that are just above where the current price is, and then I just sort of ride that trend out. That's how I'm letting my profits run and cutting my losses. If the move doesn't occur, then I just start exiting at or around the current price. But if the move is quite strong, then I just start cancelling orders and let the price run up. And that sort of almost helps the price move up as well, because my orders aren't there and it's easier for the money to move in that particular direction. Now, some of you will sort of say, well, what happens if that doesn't occur? Well, like I've just said there, basically, if the price starts to move up in that direction and then stalls and doesn't go anywhere, you just start exiting at that particular point. And I can bring up another graph where you can actually see that situation developing. This was on the same day, I think. But basically, you can see that the price came, it bounced, and then it just went nowhere. So I would have exited that trade for break even or a small loss. But one of the ways that you control the risk within the market and your potential payoff and your potential loss is to basically manage the position into the market, and then you manage the position out of the market so that you get the maximum amount that you possibly can. You're never going to get it nailed on, but if the move develops much stronger than you expect, you can take advantage of that, and if it doesn't, you just slowly exit at that particular point within the market. So once we had all of our orders in the market, it was a question of where are we going to exit. We know we're not going to get it absolutely nailed on. We're just looking for a good position within the market where we can put those closing trades and move them around and get them filled, basically. And the interesting thing about this is you would have seen the price sort of come down gently and then gradually move out. And when we're looking for the price to move out, we're basically saying we didn't want to see backing activity. So the point at which you would exit your market, you move away from the chart, you focus on the ladder, and you're looking for backing activity, basically. So whether you're looking for it or not looking for it, it can help you get in or out of a trade in either direction, basically. But as the price started to go up, we were looking for money to begin to accumulate. We're looking for regular bets or trades and positions to be opened at that particular point in time. And typically that would be reflected by an accumulation of volume at a certain point within the market. So if we actually look at where most of the volume was matched, and where the price began to stall, that told us that basically people weren't willing to lay this horse above sort of 274, 276, and therefore that was a natural point for us to get out on. Because I was capturing screenshots, I couldn't actually get out specifically at that point. A couple of my closing trades missed that particular point. But basically, there were two factors here. We could see the accumulation of money. There was very little time left before the start of the race. So based upon the fact that the price wasn't going to go any further and we could see that people were backing, which could have been closing positions as well, the amount of time that we had left as well meant that we had to get rid of all of those trades before the race went in play. So we sort of joined in the fray at or around that particular price point. There wasn't any magic in terms of the way that we decided to exit at that particular point. We were just watching the order flow on the ladder, and we also had this limiter in terms of time left before the start of the race. So the interesting thing about this particular pattern is it recurs on a regular basis, and you may have seen me talk about this before, and you may have seen me tweet out images related to this on a regular basis, because it's one of the favoured setups that I like to see within the market. But there's no reason why you can't do it the other way around. The price could have drifted and then start to come back in the other direction for a similar reason. The market tends to accommodate for both of those factors within the market. So I don't have any particular preference for doing it in one direction or the other. It just turns out that very often favourites tend to get backed. And what the market is doing here is it's trying to find that end point within the market. On this particular trade, the SP was about 260 something, I think, overall. And the market tends to follow a meandering path to that particular point. It doesn't follow a straight line, or it's very rare. You do see it now and again, but it's very, very rare. And as opinion and emotion pushes the price around, your objective as a trader is to take advantage of that volatility, to basically look at moments within the market where it appears to be out of kilter, and then to get in at roughly the right time when you see those characteristics, and then to exit it when it starts to sort of revert back into a position where the market seems to think that there's more reasonable value. And you'll notice that I'm sort of being slightly vague in terms of entry and exit here, but that is because that's the way that the market works. Every now and again you can nail it. Some of the big trades that I get are where I absolutely catch the market at just the right moment with just the right amount of money and doing just the right thing. But the vast majority of markets won't act like that. You're basically looking to get in on a particular position. You enter your trade into the market, you get a good average price. If it doesn't work out, you basically exit at the best price that you can. And if it does work out, then you try and ride that profit as much as you possibly can, exiting at the point at which the trade is beginning to break down. So yeah, hopefully that video was insightful for you, gives you a little bit more depth. And one of the reasons for using the graphs here is just to basically give you an idea of exactly what you're looking for at which particular point. I have done videos on order flow where I indicate to you the specifics that I'm looking at individual points within the market. So I suggest maybe watch a couple of those videos alongside this one to understand specifically at certain points within the market how I'm reading whether that trend has stopped, whether it's about to start, and that sort of type of activity. But by combining a little bit of price action, understanding specifically what you're looking at and confirming it with the order flow, there's no reason why you couldn't do this trade as well.